847 pages. That is the file on your desk. The taxpayer is a dentist in Ohio. He is 43 years old. He earns $340,000 a year. He has claimed $214,000 in business expenses. You open page 1. You already know something is wrong, the same way a mechanic hears an engine and knows which part before the hood is up. This is your 312th audit. You have opened enough files to know what clean paperwork looks like. This is not clean paperwork. You are 26 years old. You have been with the Internal Revenue Service for 14 months. Your title is Revenue Agent. Your salary is $61,400 a year. The file on your desk represents approximately 43 hours of work, distributed across 6 weeks, after which you will write a report, submit findings, and move to the next case. You will not go to court. You will not arrest anyone. You will not appear in a movie about your job. You will open another file. The audit did not begin with you. It began with an algorithm. The Discriminant Information Function, the DIF score, is a mathematical model that assigns every filed tax return a probability rating based on several hundred variables. The variables include income level, expense ratios by industry, geographic clustering, filing date, amended return history, and dozens of others that are not publicly disclosed because disclosing them would change the behavior of the people the model is designed to catch. The dentist's DIF score was high enough to place his return in a selection pool. A human being, a classifier, reviewed the pool and flagged his return for examination. The flag landed on your desk. What you find on page 14 is a deduction for continuing medical education, totaling $38,700. The IRS average for a dental practice of his revenue size is $9,400. The deviation is 211% above the industry median. On page 29, you find a vehicle expense deduction of $22,600. He has claimed the vehicle is used 100% for business. This claim appears on the return of roughly 4% of sole proprietors. The actual rate of 100% business vehicle use across all categories of self-employed taxpayers is estimated by the IRS Compliance Research Division at less than 1%. You have not spoken to the dentist yet. You have not called him. You have not sent a letter. You are reading a document, and the document is already telling you what happened. This is the part of the job that people outside the IRS do not understand. The audit is not a search. The audit is a translation. Someone filed a return that said one thing. Your job is to translate it into what it actually means. You draft a correspondence audit letter. The letter requests documentation for 7 line items. It is written in a specific register, formal, specific, not threatening, because the IRS legal team determined long ago that letters perceived as threatening increase dispute rates, and dispute rates consume compliance resources. The letter sounds like a reasonable request. It is a reasonable request. It is also the opening move of a process that has a predetermined range of outcomes, and the dentist is already inside it, whether he knows it yet or not. He will respond in 32 days. Most people respond in 32 days. The IRS doesn't find fraud. The math finds fraud. The auditor just reads what the math already knows. 2 years later, you are a field auditor now. You go to them. Not the correspondence, not the letters. You go to the address on the return. You sit across from the person. You ask for the records. Your territory covers a 4-county area in the Mid-Atlantic region. Your caseload this quarter is 11 open examinations. The average field audit takes between 6 and 18 months depending on complexity and the cooperation level of the taxpayer's representative. You are 34 years old. Your salary is $87,200. You drive a government vehicle. You carry a government identification badge. When you arrive at a business, the reaction is almost always the same. The receptionist goes pale. Someone in the back of the room makes a phone call. By the time you are seated in the conference room, a tax attorney has usually been retained within the hour. This is the case you will not stop thinking about. His name is James. He owns a landscaping company. He has operated it for 9 years. His annual revenue last year was $414,000. He has 3 employees, a lease on 2 trucks, totaling $3,200 a month, and 3 children between the ages of 6 and 14. His return was flagged because his labor expense deduction, $207,000, represented 49.8% of gross revenue. The IRS benchmark for landscaping operations of his size is 31 to 37%. The deviation is significant. You request payroll records. He produces them. You request bank statements. He produces them. On the 3rd day of the examination, going through a supplementary ledger his accountant prepared, you find $18,300 in personal expenses run through the business account. Meals at a restaurant 14 miles from any active job site, a payment to a home improvement contractor, a purchase at a sporting goods store dated the same week as his son's birthday. $18,300 over 27 months. Not a systematic fraud, not a shell company, not offshore accounts. A man running a landscaping company with 3 trucks and 3 employees who used the business account to buy a birthday present and dinner because the personal account was thin that month and the business account was not. And over 27 months, this happened enough times that the number became $18,300. You document it. You have no discretion here. The documentation is the job. The Internal Revenue Code does not contain a provision for cases where the taxpayer is clearly not wealthy, clearly not strategic, and clearly not sophisticated. It contains a provision for disallowed deductions and the applicable penalties and interest. You calculate the adjustment, the back taxes, penalties, and interest, total $31,900. James sits across from you at the conference table. He does not have a tax attorney. He cannot afford a tax attorney. He has his accountant, who prepared the original return and is now sitting very quietly. You explain the findings. You explain the proposed adjustment. James looks at the number. He is quiet for a long time. Then he asks if there is anything he can do. You tell him he has appeal rights. You describe the appeal process. You give him the paperwork. You drive back to the office. You write the report. You close the case. You open the next file. You will think about James for a long time, not because the outcome was wrong by the rules, because the rules are precise, instruments applied to situations that are not always precise, and the application is the job, and the job does not ask how you feel about the application. The tax code does not distinguish between the person who is hiding something and the person who is careless. The penalty schedule does not have a column for intent. The math produces the same number either way. 4 years after the field. Your title is now High Net Worth and Ultra High Net Worth Revenue Agent, Large Business and International Division. The IRS does not assign this role to everyone. It assigned it to you because your case resolution rate is in the top 11% of your cohort and because you requested a transfer to this division twice before it was approved. Your caseload is smaller now. Your cases are larger. The return on your desk was filed by a partnership. The partnership has 47 members. The primary partner is a private equity principal based in Connecticut. He is 57 years old. His share of partnership income last year was $4,130,000. He has reported adjusted gross income of $940,000. The difference, $3,190,000, has been allocated to a series of entities: a Delaware holding company, a Cayman Islands trust, 2 pass-through LLCs registered in Wyoming, and a charitable remainder trust established in 2018. All of this is disclosed. All of it is on the return. It is disclosed in a way that requires approximately 60 hours of analysis to fully understand. You have 60 hours. You spend the first 12 reconstructing the ownership chain. The Cayman Trust holds a beneficial interest in the Delaware holding company. The Delaware company holds a majority stake in 2 operating businesses that generated a combined $7,400,000 in revenue last year. The distributions from those businesses flow through the Wyoming LLCs, which are disregarded entities for federal tax purposes, into the partnership, which allocates income to the primary partner at a preferential rate established in the partnership agreement as carried interest. The carried interest rate is 20%. The applicable federal tax rate on carried interest is 20%. the long-term capital gains rate, rather than the ordinary income rate of 37%. Nothing here is illegal. You need to say that clearly, because the instinct when looking at a structure this complex is to assume concealment. This is not concealment. This is architecture. The structure was designed by a team of attorneys at a firm that charges $900 an hour. Every entity exists for a documented business purpose. Every allocation has a legal basis. The tax benefit, the difference between the 20% rate and the 37% rate, applied to $3,190,000 is approximately $543,000. That benefit was purchased for approximately $270,000 in legal and accounting fees. The return on the investment is approximately 2 to 1. You identify one issue. The charitable remainder trust received a contribution of appreciated real estate valued at $4,300,000. The valuation was performed by an appraiser the primary partner has used on 4 previous occasions. The IRS has an informal threshold, not a published rule, an institutional understanding that appraisers used repeatedly by the same taxpayer require additional scrutiny. You order a second appraisal through an IRS-approved valuator. The second appraisal comes in at $3,680,000. The difference is $620,000. The deduction overstated. The adjustment, with interest, is $147,000. The primary partner's attorney calls you the following morning. The call is professional. He has reviewed your analysis. He would like to discuss settlement options. You discuss settlement options. You reach an agreed adjustment of $112,000 after concessions on both sides. The case closes. The primary partner's total tax liability for the year, including the adjustment, it is approximately $930,000 on $4,130,000 in partnership income, an effective rate of 22.5%. James, the landscaping company owner, paid an effective federal rate of 19.3% on $414,000 in gross revenue before the $31,900 adjustment you assessed 2 years ago. You write this in your case notes and then you delete it because it is not relevant to the case file and case files do not contain observations of this type. Below $500,000, people hide money. Above $5 million, they move it legally into structures that look like compliance. Both are rational responses to the same system. The system treats them very differently. 7 years after the beginning. You are 33 years old now. You have examined 419 returns. You have recommended 211 adjustments. You have referred 7 cases to the Criminal Investigation Division. 7 times in 7 years, you found something that crossed the line between civil noncompliance and willful tax fraud. The line is not always clear. The standard for criminal referral is not a number. It is a pattern of behavior that indicates the taxpayer knew what they were doing and did it anyway, repeatedly, with awareness of the consequence if discovered. The case that went to the Department of Justice began as a routine high net worth examination. The taxpayer was a physician. His practice generated $3,800,000 in annual revenue. He had been filing returns for 19 years. For the first 12 of those years, his returns were unremarkable. For the last 7 years, he had been routing practice revenue through a management company he owned with his wife, deducting the management fees as business expenses and not reporting the management company income on his personal return. The management company had no employees. It provided no services. It existed to receive money and not report it. The unreported income over 7 years totaled $2,940,000. The tax owed on that amount, at his applicable rate, was approximately $1,160,000. With penalties and interest, the total civil liability was $1,730,000. The civil liability was not the referral basis. Failing to report income is not automatically criminal. The referral basis was a specific document you found in the 11th week of the examination, an internal memo written by the physician's own accountant in 2019, advising him to dissolve the management company because the structure was, in the accountant's words, not defensible under examination. The physician did not dissolve the management company. He filed 3 more years of returns using the same structure. He had been told it was indefensible. He filed anyway. You complete the civil examination. You write the criminal referral memorandum. You send it to the Criminal Investigation Division. CI reviews it over the course of 49 days. They accept the referral. They open a criminal investigation. This takes 11 months. The case is then referred to the Department of Justice Tax Division. The DOJ reviews the referral and decides to prosecute. The prosecution takes 22 months to reach trial. The physician is convicted on 6 counts of tax evasion. He is sentenced to 37 months in federal prison and ordered to pay the full civil liability plus additional restitution. You are not in the courtroom. Your involvement ended when you completed the referral memorandum and testified before the grand jury. You followed the case through the public record because it is your professional habit to follow the outcomes of cases you refer. When the verdict comes in, you read the press release. You close the browser. You have not thought about the physician's family. You have thought about the physician's family. His wife, who co-owned the management company and was investigated and not charged because prosecutors determined she was not aware of the structure's purpose. His 2 adult children who were practicing in the same medical system as their father and who gave statements to federal agents on a Tuesday afternoon in October. The practice, which employed 16 people and was sold at a distressed valuation during the investigation. You think about all of this. You think about it with a specific kind of precision, not guilt, not satisfaction, but an awareness of the weight of a process that moves forward regardless of everything adjacent to it. The process does not stop because of the family. The process does not stop because of the employees. The physician knew what he was doing. He did it for 7 years after being told to stop. The process produced the outcome the code specifies for that sequence of events. You still think about it. You think about it the way you think about James and his $18,300 and his 3 kids and his landscaping trucks, not because they are equivalent situations, because they are both examples of what happens when the code meets a life, and the code does not flinch, and sometimes the life does not recover. The Criminal Investigation Division does not decide who goes to prison. The taxpayer decides who goes to prison. The Criminal Investigation Division just reads the record they created. Every document, every transaction, every year they filed after being told to stop, the record is always the taxpayer's. The auditor just translates it. You are back at the desk. The file is still 847 pages. The dentist is still 43 years old. He still earns $340,000 a year and has still claimed $214,000 in business expenses. None of that has changed. You have just read page 1. By page 40, you will find what you are looking for. You always find it by page 40. Not because you are exceptionally skilled, though you are, at this point, exceptionally skilled, but because the return already contains the answer. The return is a document the taxpayer created. Everything in it is a choice they made. Some of those choices were careless. Some were deliberate. Some were the result of advice from an accountant who told them what they wanted to hear. Some were the result of not understanding the rules. Some were the result of understanding the rules very well and deciding to test them. The IRS will examine approximately 330,000 returns this year. That is approximately 0.2% of the roughly 160 million returns filed. The people whose returns are examined are not selected randomly. They are selected by a model that identifies the returns most likely to yield a significant adjustment. The model is not perfect. The model does not need to be perfect. It needs to be correct often enough that the revenue recovered exceeds the cost of the examination process, which it does, consistently, by a ratio the IRS does not publicly disclose, but which internal compliance research estimates at approximately 5-to-1. Most people will never be audited. Most people know this. Most people have used this knowledge to make decisions about their returns to round numbers, to claim deductions they are not certain are allowable, to omit income that feels difficult to document, to adopt a posture toward the tax code that is optimistic about ambiguity. Most people are right that they will never be examined. Some of them are wrong. The dentist is in the sum of them. He does not know this yet. He is in his office in Ohio. He is seeing his 3rd patient of the afternoon. He has not opened his mail today. In approximately 32 days, he will open a letter. The letter will be formal and specific and not threatening. It will request documentation for 7 line items. He will call his accountant. His accountant will call a tax attorney. The tax attorney will call you. You will be on page 40 by then. The IRS doesn't come for most people. It waits. The math is patient in a way that people aren't. And the file is always there, the return they filed, the choices they made, the number the model produced. The IRS didn't create the file. They did. The IRS just reads it.